as we pursue to build our wealth. Capital is the amount of money that you have at your disposal for investment. Investing will never be successful if you are only having one option. You need to have a array of opportunities that you are going to compare. You use data, analyze that data, and the results is what you are going to use to compare or rank those opportunities. Then allocate the resources or the capital that you have according to their returns. Investment, unlike saving we keep our money in options that protect it against inflation. And in any case, we get something extra, that is growth. So primarily in saving, we are protecting our money against loss and inflation, where inflation is the persistent increase in prices of commodities and services. And that ensures that in future, when we want to use that money, we will be able to get whatever items or product that we have planned to acquire, all the service that we want to acquire, by virtue that as the price increase or change, our money will also be increasing by the rate of inflation, so that by that future date when we want to spend or utilize that capital, then it will have increased or grown to that price or more. Therefore, a portion of the interest rate that we look for has to be above the inflation rate for purposes of our savings. But investing needs more than saving. Investing requires management of that cash, because unlike saving, investing is putting our capital in opportunities with a view of positive results. That means that we need to monitor the investment with a view that in the event the investment gives us negative results, we'll be quick to mitigate such events that will result into negative results by liquidating investment and putting our in other options that are giving us positive results, unless we forecast that the events will change and the negative results will be compensated by future increased or future positive results. In our evaluations, if, for example, you take 1,000 shillings, and I choose 1,000 because we have many opportunities that we are embracing, especially in money market funds, that will give us low entry points or low initial investment amounts and top-up amounts, and to be specific, over 100 shillings. And look at the returns that we are going for vis-a-vis other opportunities. And in this case, I want us to compare if you used your capital to venture into business or to create your wealth through enterprise. If you take that 1,000 and you buy a product in the market, pay a visit Kamkunji, buy your own product and retail it, chances are that there are so many purchases or products that you can buy and retail them at a double price or get over 50% of the price at which you bought. And the same investment, once you sell that item, you receive your capital plus the markup or the profit. You have an opportunity to buy again, sell, buy a third time and sell. Those purchases, those cycles, we call them portfolio rotation or business rotation or stock rotation. The number of times you are able to rotate that investment or that purchase, the number of times you can purchase and sell within a specific period of evaluation, that determines your profits and margins. And so to say then, wealth, if you are able to establish a business, whether you are offering service or a product, you can generate high amounts or higher percentages of returns as compared to all these other opportunities. Many of these schemes that we have in the markets which we invest, those schemes are businesses of other people. And no one creates a business for purposes of profiteering other people. Those schemes belong to people. And in maximizing the returns, you will always get a lesser amount than what you would get if you were investing yourself. When I talk of business, I'm not talking of side hustles per se. A side hustle is a detraction. It detracts you from your main business or your main work. I'm talking about real business. And real business, we can distinguish it from a side hustle in 4 points. Number one, a real business will be offering a solution. Once that solution, you have offered a solution, you get money in return. The money that you have gotten, you will going to analyze and review the business of that solution with the purpose of expanding. That's how you make a sustainable business. Businesses offer solutions. You have to identify a need in your target market, then tailor a solution for that need. You are in business. But if you venture a side hustle is a term that we have conventionally majorly used to refer to whatever else we are doing outside maybe employment or our main activity or active activity with a view of generating money. I know side hustles also, we have used it to refer to business. But real business for wealth creation will be based or founded on offering solutions. When you are doing business or when you are starting a business, everything that will come into that business, everything that you are going to have in that business, those are assets. Those are assets, whether dead, alive, or whatever other term will be described. At the end of the day, those are assets. Then on the other side, we'll be looking at providers or funders of those assets. When we take the total amount or the total value of all the items that are in the business, those are the assets. We'll now match that with how they were purchased or how they were funded, how they were acquired. The amounts that came from you as the owner of the business to acquire those assets, that is what we will call capital or equity. Then whatever else you obtained from other people or banks as loans, that will be debt. And debt in general, we refer to such resources as liabilities. So the term liability in business is used to refer to resources that you obtain to other people or relating to other people that were used to finance the assets in business. Whatever is financing the assets in the business and came from the owner, that is equity or capital. We reserve it for capital. But in a broader perspective, capital will be now referred to when you use liability and specifically refer to what is coming from the owner as equity. When we say capital, we have debt capital and equity capital. But as a beginner or at the very beginning, it's good we look at assets in total as all the things of value that are in the business. And now we look at the source of the finances that we are used to acquire these assets. The proportion that comes from the owner of the business or the owners, that is what we reserve to refer as capital, and proportion that we are getting from other parties or person, that becomes liabilities. So in the context of business, I know in personal finance, many a times we refer to assets as your possessions or things that you own that take money away from you or that require money from you for maintenance. That is, they don't generate sufficient enough that can be used to maintain them. Pure from accounting and finance, I would reserve that one for other discussion. But in the best for business, those are assets. And assets, in most cases, you need to broaden that aspect, the scope of the term asset, and look at not just stock, furniture, motor vehicles, and other things that belong to the business itself, but also employees are assets. That is human resource, that is asset. Customers are assets. If you are to buy an existing business, you buy into its assets. And asset includes information and systems that have already been established. The market that exists that you are purchasing into, that is forms part of the assets. And one important thing that you need to look at when you are talking about business, and this is the primary killer of small businesses or startups. Statistically, most startups have a mortality rate of about 5 years. Like that, most businesses from the time they get incorporated and established, it takes them on average of not more than 5 years before they collapse. Meaning their struggles would have initiated in the second year or even first year. Others, that is an average rate of 5 years. So it means that others can even collapse in months from establishment. And one of the greatest killers of businesses that you should avoid if you choose to generate and create your wealth through business, one, we call it drawings. And the drawings, remember we have said that whatever assets, all those things that are in the business, what comes from the owner, we call it capital. What comes from other parties, we call it liabilities. When you take assets from the business and give it back to the providers of capital who are not you, part of you as the owners, those are the funders, the liabilities, you reduce those liabilities. A good example when you talk about assets so that we don't create confusion is that business is about converting the asset. You put in money, 100,000 as your capital, convert this 100,000 into working capital, you buy goods, that is your stock. You buy a few items that you may require in the business as furniture and all that. You have converted cash into items. Furniture, then we have stock. When you sell this stock, you have converted item back to cash. When cash moves out from the business, you're reducing assets. And because on the other side where we are, the book where we are recording what we got from other people as liabilities, when you pay them back, you reduce that value. But we are not teaching accounting. So back to the discussion. If the assets in the business, when you take a portion of them and pay back liabilities or other providers of financing to acquire these assets, the liabilities, it also means whatever we shall take from the business as the owners for our own private use, that reduces our capital. When the assets flow out of the business to the owners for their personal use, that reduces the capital element or the capital value as per the records in the books. Whatever assets flow out the business to funders who are not the owners of the business, that reduces liabilities. So that in essence, the general term that we use to describe assets or items of value obtained from the business by the owners for their personal use, we call it drawings. Drawings is one of the key killers of businesses. You start a business and you start consuming the items that are in the business without you paying. Those are drawings. In most cases, small business people bring in, they often fund the business without even recording, and they will consume from the business without the recording. That's primarily what kills the business. And now by extension, we will describe the drawings into 3 ways. And I will have to put it in a Kenyan way to make it sweeter. When you eat stock from your business, because that is the most item that is abused, stock and cash. When you misappropriate cash, meaning that you're using that money for things that it was not meant for. And there is only one thing that business cash is made for. It's made for business. If you use that cash for other things that is not meant for, you have done a drawing. And cash from your business or stock, the money, assets from the business will be flow out in 3 ways. One is you as the owner of the business, you are eating your stock or money. Those are drawings. And that's why we say in Swahili, usikule stock. Ukikula stock, unakula biashara. The other two ways you are going to ruin the business and keep the business through drawings is when now you bring in two other people to start eating the business with your help, or they help you do your drawings. And that is when you engage with your staffs in a manner or in the relationships that defy the principle that separates you and the worker and the business. And that's why again in Swahili we say, usikule mfanyikazi. Usikule mfanyikazi. The problem with that relationship is, this worker or this staffer who is in direct contact with the asset, cash or stock, acquires entitlement. They start getting entitled. They feel entitled and they start accessing money and stocks without any permission. And you as the owner of the business, you lose your authority over that person. You find that this person has embezzled 10,000, 50,000, 100,000, and you lack that moral authority to question or even reprimand the person. You'll be told that this money, I send it to my parent, this money I did, and they will feel it's like it's what they are right. Unless you have enough systems that you can use to manage such relationships, because one person whose such a relationship could be doing or working and not hurting the business cannot be a perfect representation or representative of all the businesses. Many businesses come down because of such relationships. Usikule mfanyikazi. The third relationship that will kill the business is when you get too cozy with the customers. Some cases, customer can build, you can build a relationship, but in most cases, Swahili again, ukikula customer, usikule customer. When you build such cozy relationships with the customers, it becomes again a huge problem if you are going to pursue such a person or customer to recover a debt. Because the very first thing that will crop in is that such customers will start taking things from the business on credit. And again, they will feel entitled. And that sense of entitlement, even in normal life of an employed person, when you have relatives, when you have friends who can predict when you are going to be paid, how much you are paid, they acquire entitlement over your salary. And that's why they will make their calls to ask for money at exactly around the time that you get paid. That sense of entitlement is the worst, is the enemy of your growth in wealth creation. Because it not only breaks the barriers of generosity, but it creates what I normally call financial incontinence. You lose your control over your money. Relationships in business that engage the customer, the employee, and you as a person, if you lose that control over your assets in business, that is stock and cash, that level of incontinence, that is the primary reason that business is bound to collapse. It will not take too long before that business starts struggling. And the next thing that you will find yourself getting into, you now get into bad debts. Even when we say consumer debts are bad debts, and we say that business debts are good debts, it's only business debts that are put into use or into business activities that are generating more than what you need to pay that debt. You are able to service the debt and be left with cash from profits. You are not selling an item of asset to repay the debt. You take a debt of 40% or 30% when your business is generating profits of 20%. Where are you getting this extra 20%? to repay that debt. It means you are paying the debt and you are taking a 20% of your existing business and giving it away. So the point driven home is avoid drawings. And the drawings in business are coming through those three ways. Ukikula mfanyikazi, ukikula customer, ama wewe ukule stock. Hope that one will help us in enhancing or keeping our business alive. Thank you for watching.